presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for December 9th, 2024. I'm Moe Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, I want to remind all of you, click on the subscribe button so whenever I post an update, you will be notified and you can watch it at your convenience. It is absolutely free, so don't forget, click on the subscribe button. Looking at the numbers, last week, another great day in the markets. Market is up nearly 23.33% for the S&P. Last week, we gained nearly 1% for the S&P. Dow was down slightly. NASDAQ had a great week, up 3.36%. And the Russell Small Cap Index lagged a little bit, down 1.02% for the week. So it was a mixed week. NASDAQ came back up, but S&P in the middle, Dow down a little bit. Consumer discretionary led the way last week, up 5.9%. So it was a great week for consumer discretionary. Seems like the consumer is still there. They're shopping. Shopping numbers are good for the holidays. Energy was the worst sector last week, down 4.5% for the week. Utilities and the rest of them were sort of in the middle. Technology and communication services, which is also technology, were the second and third best sectors last week. Overall, markets continue to move higher. And as we look at the end of the year, it's been a fabulous year for the markets. Looking at next year, I don't know if we get another year like last year. Most of the guesses from most major firms, Goldman Sachs, is about 6,500 for the S&P, which would be a gain of about 6%, 7% from where we are. Some of the other firms are higher. Goldman Sachs is at the lower end. The higher end is about 7,000 for the S&P, which would be a 20% gain. I think we end up somewhere in the middle. That's the way I'm looking at it right now. I'll take a look at the charts, and I feel like we are a little bit overbought right now. The bullishness is really high right now. Everybody's feeling a little too comfortable. When that happens, markets have a tendency of getting a little choppy, but we do have the Santa Claus rally, seasonal time of the year when the markets move up. So I think between now and the end of the year, we could get another move, a little bit more to the upside, and then after that, everybody will get a little anxious with the new administration coming in, and it'll take them a couple of weeks or a couple of months to get settled down. And once that happens, everybody will say, well, the world has not ended and everything is going to be okay. And from there, I think we start looking back at the fundamentals of the market, which is interest rates are coming down, markets are doing well, our economy is doing great, and whenever interest rates come down, usually if you look at the 6-month, 12-month, 2-year numbers from when the Fed starts to reduce rates, the markets have done well, except when there's a recession. And I don't see a recession coming at this point right now in 2025. Now that could change if we get a trade war and tariffs go up dramatically, inflation starts to go up dramatically, and the Fed has got to come in and raise interest rates to curb inflation, and that could create some, but I don't see that happening. I think, again, there'll be a lot of talk of tariffs, but then we'll get some tariffs, but they won't be as large as everybody is worried about. Oil continues to go down, and then we've seen the dramatic move in Syria, where Bashar al-Assad is out after the Assad family has been running the Syria for like 50 years or so. And now there's a new administration, whatever you call it, in Syria. We don't know exactly how it's going to end up, but I think overall it's going to be good for the Middle East. We'll have to wait and see. It's always a mess there, and you never know which way things are going to go. But that put pressure on the oil market to the downside. Interest rates also slightly lower. From 4.18, we went to 4.15 for the 10-year. And as you've heard me say, as long as we are between 4% and 4.5%, I think we're okay. That's where the sweet spot is for interest rates. Going below 4% would mean the economy is slowing. The Fed has got to bring rates down to stimulate the economy. A slower economy is usually not good for the stock market. Looking at the employment sector, share of payroll growth we are seeing is healthcare is going up, as you can see, and the government spending share of non-farm payroll total. It is total non-farm payroll for 22 employment growth. You can see that government has been one of the largest growth areas, and we have to make it a smaller, more efficient government. How is that going to happen? When is that going to happen? Again, there's a lot of talk of cutting regulation, which would be good for business, but we'll have to wait and see what gets accomplished. So these are the areas that manufacturing jobs are still, you can see, in the negative right here, and that's not a good sign. But overall, health industry continues to move. This week we get the CPI, the Consumer Price Index. Again, it's sticky, expected to be around 0.3% is the number. That's the consensus number everybody is expecting. Last month we had 0.2, so just staying around there, not very, very big. Then they get the Producer Price Index, also expected to be the same at 0.2% compared to what we had last month, which is also 0.2%. Guess was initial claims are 220. Import prices, export prices, those don't have. So the big numbers are going to be the inflation number this week, but then we have the Fed meeting next week. Expectation is the Fed is going to lower interest rates by 25 basis points, or 0.25%. I think there is a good chance that they're going to do that, but where do they go after it? Market is expecting 4 more cuts next year. We'll have to wait and see. I think a lot will depend on how the inflation numbers come out. The Fed is going to wait and see what kind of tariffs we get, what impact they have on the economy. Is it a slowing economy where the economy slows and that brings inflation down, or prices go up and that brings inflation up? We'll have to wait and see. Last time under the Trump administration, we heard a lot about tariffs. Inflation actually went down, not up. Most of the tariffs, the goods that the tariffs were placed on, those prices did go up a little bit, but the rest of the market prices came down. So overall inflation came down, even with tariffs being imposed. And in the last administration, again, they were not dramatic. There were selected tariffs, and I think we're going to get the same thing. Looking at the technicals right now, S&P is at a 5th wave. Usually when we have a 5 like we did right here in July, you get some kind of pullback. Here we've had 5 waves. Pullback will bring us down to about 6,000 is the 20-day moving average. 5,900, 5880, 5,900 is the 50-day moving average. I think we get, after a 5th wave, we can get this A, B, C, A down, B up, C down, a corrective move. So if we get an ABC, we could come down towards the 5,900 area. 5750 is the 20-week moving average. If we get below 5,900, we could see 5750. That would be about a 250-point decline, 3-4%, just a normal pullback. And that, I would view that as a buying opportunity. If we do get that in the next few weeks, I think that could set up as a good opportunity to take a look at. NASDAQ, same thing, 3rd wave. We could see a 4th wave pullback and then a 5th wave rally. That's what I'm looking at. Same thing with the weeklies on the NASDAQ. I think this will turn into wave 3 instead of wave 5 that we see here. And then we'll see a 4th wave and a 5th wave to the upside. 10-year note today trading around 4.195. The 200-day weekly average is around 4.204 today. So it's right there, right at the 200-day moving average. 50-day is about to cross over the 20-day, which 200-day, which is usually rates are going up, but I don't think that'll mean much here. I think as long as we stay around 4% on the downside and 4.5% on the upside, somewhere in this vicinity, I think that would be okay. That's the Goldilocks. If we get much below 4, then everybody will start worrying that the economy is slowing down, and that is why we're seeing interest rates coming down. If we get above the 4.5, then I think everybody will start, the narrative will become, oh, inflation is coming, and that's why rates will not going to come down. Small caps, this touched this high right here that we saw in 2021. This is a weekly chart. Each one of these vertical lines, red and green, are 1 week of trading. You can see that it's a little bit overbought, and we're seeing a 5th wave. We needed to break out above this, and we'll have to wait and see if we can. I think the only way that happens is if interest rates continue to come down. Oil prices were down quite a bit last week. They're coming back up today, about $1 a barrel higher, just back and forth. But still, the trend is to the downside, and I think support is right this low right here that we made in September, which is 65.27. We're at 68.23, so not too far away from that today. Gold's just sitting at the 50-day moving average. We've seen wave 1, 2, 3 to the downside. 4s are really choppy. I still think somewhere around 2,500 to 24,750 to 2,500 is a place to look at the gold market if you're not in. Bitcoin, it's been doing okay. This is last week's chart. I think any pullback down to about 50. This is the ETF for Bitcoin. The symbol is IBIT. So if you are looking to get Bitcoin, add a little bit of the new gold, as it's being called by all the young people. Gold is old-fashioned, the old gold. This is the new gold, is Bitcoin. If 2 or 3% on your portfolio and you pull back could be a great way to participate in that, buying an ETF. Those are my thoughts. Again, don't forget to subscribe to this channel. Whenever we post an update, you will be notified. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.